QQQs outpacing SPYG over 3 years, despite identical 1 and 5-year returns. That's where the real recovery story reveals itself. Let's dig into the details. QQQ crushed SPYG by 14 percentage points over 3 years. That's the kind of gap that turns into serious money when compounded. Both funds delivered identical 22% returns this year. Starting from the same spot makes our head-to-head comparison perfectly fair. In plain English, so here's the deal with 1-year returns. Imagine race cars crossing the finish line at exactly the same moment. Dead heat. After 12 months of racing, they're neck and neck. But here's where the story takes a turn. QQQ's 125% 3-year return shows where performance really starts separating from the pack. That's when divergence becomes undeniable. Let's take a closer look. SPYG delivered 111% over 3 years. Impressive gains, but you can already tell it's lagging behind something even stronger here. Now let's put this in perspective. Identical 102% 5-year returns prove that despite short-term differences, both funds deliver nearly the same long-term performance for investors. In plain English, think of total returns like marathon runners. They might sprint at different paces through the middle miles, but what really matters is whether they cross the finish line together at 5 years. Now let's connect the dots. The Sharpe ratio is what really matters here. It shows you whether you're getting paid fairly for the risk you're taking. Let's break this down further. QQQ's delivering solid risk-adjusted returns here. You're getting 1.3 units of return for every unit of volatility you're taking on. But wait, there's more to this story. SPYG's Sharpe ratio of 1.2 shows decent risk-adjusted returns, though it's converting volatility into gains slightly less efficiently than peers. In plain English, think of the Sharpe ratio like a car engine's efficiency. QQQ squeezes out 1.3 miles per gallon of risk, while SPYG only manages 1.2 miles. Better returns per unit of turbulence. Sortino's smarter than Sharpe because it only penalizes losses, not gains, measuring the downside risk that actually hurts your portfolio. Let's zoom in on this. QQQ's 1.8 Sortino ratio means you're getting solid returns without getting hammered too badly when markets drop. Pretty impressive downside protection here. But that's not the whole picture. SPYG's 1.7 Sortino ratio means it's managing downside risk well, nearly matching QQQ's efficiency when markets get rough. In plain English, the Sortino ratio measures downside protection, how well your investment cushions falls. Think of it like tightrope walking. QQQ's got a slightly thicker safety net catching you when things go wrong. Now let's flip the script. Volatility measures price swings. Higher numbers mean wilder rides. 3-year volatility shows how much these funds actually bounce around daily. But there's a catch. QQQ's 20% volatility reflects its tech-heavy portfolio. You get Nasdaq's upside potential, but you're signing up for bigger swings. Let's get into the weeds here. SPYG's broader diversification keeps volatility at 18%. Smoother rides mean less drama when markets get choppy. In plain English, volatility is just roller coaster intensity. QQQ's got those heart-stopping drops and thrilling climbs, while SPYG gives you a smoother, gentler ride. Pick your comfort level. Time to make your call. Which fund takes the crown? Let's unpack this a bit. Maximum drawdown reveals the worst nightmare scenario, how deep your portfolio can plunge before climbing back up. Brace yourself. But hold on a second. A 35% drop is gut-wrenching. Imagine watching a third of your investment vanish during QQQ's worst 5-year stretch. Here's the thing though, SPYG's 33% crash is slightly better than some rivals. But let's be real, that's still a brutal hit to your portfolio. In plain English, maximum drawdown shows how far you can fall. Think of it like a building crumbling from the top. QQQ collapsed 35 floors. SPYG dropped 33. That's the pain you'd endure during crashes. But here's where it gets interesting. After a crash, recovery time tells you everything. How long you'll be stuck waiting to break even again. Let's dig into the details. QQQ bounced back from a 35% crash in just 405 days. That's resilience you can actually count on. Now let's shift gears and look at 504 days to recover from a 33% drop. That's nearly a year and a half of waiting and hoping. In plain English, think of recovery time like a marathon runner after they've tripped and fallen. QQQ bounced back 99 days faster. Getting up quicker when markets knock you down matters more than you'd think. Let's break this down further. 99 days faster recovery meant QQQ investors started building wealth again 3 full months earlier. That's serious money left on the table. But here's where the story takes a turn. Best year returns reveal how high these funds can fly when everything clicks. It's your upside blueprint in action. Let's zoom in on this. QQQ's 55% best year shows what NASDAQ concentration can do when tech absolutely dominates. That's explosive upside potential right there. Now let's put this in perspective. SPYG's best year hit 37%, solid growth. But it's playing a different game than QQQ's explosive peaks. But wait, there's more to this story. When the market's soaring, QQQ outpaces SPYG by 18 points. That's the NASDAQ tech advantage at full throttle. In plain English, when everything aligns perfectly, QQQ can absolutely explode. We're talking an 18-point surge in its best years. That's the fireworks burst moment every tech investor dreams about. So, here's the trade-off. QQQ crushes it with 125% 3-year returns and faster 405-day recoveries, while SPYG keeps things steadier with 18% volatility and smaller 33% drawdowns. Let's zoom in on this. The worst year return reveals just how brutal things can get. It's the maximum pain you'd need to stomach and survive. Let's see how this plays out. QQQ's worst year saw a brutal 42% drop. That's what happens when you're heavily concentrated in tech stocks. Here's what really matters. SPYG's worst drop was 37%. Painful, sure, but 5 percentage points less brutal than QQQ's worst crash. In plain English, when markets crash, QQQ gets hit harder, like facing a Category 5 hurricane. SPYG? More like a Category 4 storm. Less tech concentration means less devastation when things turn ugly. But there's a catch. Fees aren't just numbers on paper. They're real money that won't grow for you over decades. Let's break down what you're actually paying. Let's get into the weeds here. SPYG keeps costs incredibly low at just 0.04%. That's only $4 per 10,000 invested annually. Here's the key takeaway. QQQ keeps costs low at just 0.2%. That's only $20 per 10,000 you've got invested each year. Now, let's flip the script. SPYG's fees are 1/5 of QQQ's. That gap compounds significantly over decades, keeping more money in your pocket. In plain English, think of expense ratios as couch change. You're dropping between the cushions every year. QQQ is asking for 5 times more coins than SPYG. That adds up over time. But hold on a second. Spreading your money across more companies means less drama if one investment tanks. That's the diversification advantage we're measuring here. Here's the thing, though. SPYG spreads your money across 217 growth companies. That's solid diversification without putting all your eggs in one basket. Now for the real question. QQQ's holding just 102 companies means you're taking on concentration risk, half the diversification that SPYG offers investors. In plain English, SPYG spreads your risk across twice as many companies, 217 holdings versus QQQ's 102. Think of it like this. More egg baskets means fewer broken eggs when one basket drops. Meanwhile, tech concentration drives everything. When you're heavily weighted here, expect wild swings in performance that mirrors the sector's mood. Here's where the story takes a turn. QQQ's loaded with tech at 53%. That's basically betting half your portfolio on one sector. High conviction, high risk. Let's dig into the details. SPYG's 48% tech allocation is still concentrated, but spreads risk better than funds pushing past 50% in one sector. In plain English, here's the pizza slice breakdown. QQQ loads you up with 53% tech concentration, while SPYG gives you a more balanced 48%. It's a subtle difference, but it matters when tech swings hard. Here's where it gets interesting. Beta measures how much your fund swings compared to the S&P 500. Higher beta means you're in for a wilder ride. Let's break this down further. QQQ's beta of 1.3 means it's more volatile than the S&P. Expect bigger swings both up and down. But here's where the story takes a turn. SPYG's 1.2 beta means it swings 20% harder than the market, amplifying both your wins and your losses significantly. In plain English, beta is your portfolio amplifier knob. QQQ cranks market moves to 1.3x volume. When markets rise or fall, you're feeling it 30% louder. SPYG's dialed to 1.2x, slightly more restrained. Now let's put this in perspective. Assets under management reveal investor confidence. Bigger funds offer better liquidity and more stability when you need to trade. But wait, there's more to this story. QQQ is managing over $400 billion here. That's one of the biggest ETFs you'll find anywhere in the market. Here's where things get revealing. SPYG manages $46 billion. Substantial firepower, but still 9 times smaller than QQQ's war chest. In plain English, assets under management shows investor confidence, and QQQ's couch is clearly more comfortable. With 9 times more money stuffed in, it's not even close. So which ETF wins? If you're moderate, SPYG's your growth play. Aggressive? QQQ delivers tech-heavy firepower and faster bounce-backs. In plain English, think of it like choosing between 2 race cars. SPYG's the reliable sports car with lower maintenance costs, while QQQ's the turbocharged racer that goes faster but costs more to run. Here's what really matters. You're responsible for your decisions. Do your homework, talk to pros, invest smart. Now let's connect the dots. That's a wrap on our ETF analysis. Hit subscribe if you want more breakdowns like this delivered weekly. See you next time.